This week's winner, software names finally catching a bid. This week's loser, the AI infrastructure trade, from freshly priced IPOs all the way up to SpaceX.
And when the two dominant themes of 2026, AI infrastructure and mega IPOs, both crack in the same week, you have to ask, where do we stand? Is this a healthy reset or the start of something bigger? Let's get into it.
Welcome to the IPO Winners and Losers podcast. I'm your host, Avery Marquez, Renaissance Capital's Director of Investment Strategies.
And I'm Matt Kennedy, Senior Strategist at Renaissance Capital.
Quick note before we dive in, this podcast is for informational purposes only, and nothing we discuss should be taken as investment advice or recommendation to buy, sell, or hold any security. Past performance does not guarantee future results, and one cannot invest directly in an index. For the full disclosure, check the end of this recording. So let's walk through the week because for the first time in a while, the market didn't say no, it screamed.
Hmm.
Two IPOs pitched AI infrastructure and both stumbled. More cracks in what has been, until recently, the year's hottest trade.
Yeah, and it wasn't just the new issues. SpaceX broke below its $135 offer price for the first time. That means the two pillars of this year's market, AI infrastructure and mega IPOs, both wobbled in the same week. And to that point, the year's next largest IPOs, SK Hynix and Cerebras, also pulled back this week.
Yeah, I think it's fair to say that this was driven mostly by that broad sell-off in AI stocks. The circular spending concerns just seem to keep getting louder. But the macro didn't help. We have the Iran war still simmering on top of potentially shifting Fed policy.
Yeah, I mean, you've got concerns over AI valuations, leverage, and competition also in the mix. But Avery, much of this isn't really new. I know that last week we talked about that barrage of negative headlines, as well as some of the IPO volatility bubbling under the surface of a calm VIX. At the same time, I think it's important to keep this in perspective. Even after that 8% drawdown this week, the IPO index is still up 15% for the year. So this is a pullback inside of a strong year rather than a collapse.
Yeah, that's definitely a fair point and maybe a silver lining
Hmm.
in what looks not so great right now.
Mhm.
And with that, let's move to the deal side, starting with the two that actually made it out the door. We had Csquare, the data center operator, that priced below the range at a steep discount to peers and still finished down 2%. So when a sizable discount can't really buy a pop, I think that's the market talking.
Yeah, and it wasn't just that sentiment shift in AI. I think both of these companies had some company-specific risks as well. With C-Square, it's a roll-up with high leverage and ongoing losses. Its closest peers are established REITs that are both paying dividends. Investors had a safer way to own the same theme. And despite a very attractive EV to EBITDA here, in a week like this, investors were just looking a little bit more closely at the net margins and the debt profile.
hmm Yeah, and with the other deal, we had Standard Nuclear, and that was definitely a rougher debut.
Mhm.
That's the early stage nuclear fuel maker. And this one slashed the offering by more than half ahead of pricing. Priced as expected, but then plunged 18%.
And continue to trade down from there. That one's a sentiment story as much of a company story here. Recent IPO X Energy trading very poorly. I think we highlighted that last week. And with appetite for speculative growth cooling, Standard Nuclear just walked into a room that had already emptied out. Now, a 30% loss is not good, no doubt. But I do think it's worth pointing out that this company priced at a $2.7 billion market cap with virtually no revenue. Even now, a $1.9 billion market cap is nothing to sneeze at. So I think that there's still, I mean, that still says something. I don't want to sugarcoat that loss. But I mean, a few years ago, you might not expect a, $2 billion company to be able to go public with virtually no revenue. So that
hmm
that lottery ticket trade still, I don't want to say it's dead. There might be some legs there.
Yeah, and you look at the deal size, I mean, that was like I think, a 58% cut.
Hmm.
Um, but then, yeah, you absolutely have to look at that valuation. 150 million deal size is, maybe on the smaller side of what we've seen this year, but almost a $3 billion market cap is,
Yeah.
yeah, yeah, nothing, that's not small. And what strikes me with these two deals is that they're exactly the kind that would have flown like 6 weeks ago. So
Hmm.
we're seeing the same themes, the same pitch, but a completely different reception. And we always say market conditions can change on a dime, and this is pretty textbook.
And I think you can make the case that the market isn't rejecting AI infrastructure as a story entirely. It's just not paying any price for it. So just a case of discipline reasserting itself here. And it's kind of interesting. I know that these two deals look very different, a provider of co-location services and nuclear fuel, but between C-Square's leverage on profitability and Standard Nuclear's early stage, I think they kind of had some similarities too. These are both high-risk bets on that AI build-out thesis, and the market just didn't take it this week.
Hmm. Yeah, and seeing these cracks kind of tie them into a bigger theme because the biggest IPO in history just crossed a line nobody really wanted to see. SpaceX below its IPO price for the first time since listing. And symbolically, that's a big moment. The flagship of the mega IPO era is officially trading underwater.
Yeah, and it matters beyond just SpaceX. IPO investors, along with the mega cap unicorns eyeing the window, namely OpenAI and Anthropic, they just watched the year's anchor deal break issue. I wouldn't go quite so far as to say that when SpaceX sneezes, the IPO market catches a cold, but SpaceX is so large that a sell-off could turn a collective gain on 2026 IPOs into a collective loss. I mean, like
Hmm.
a 20% decline for a $75 billion deal. That's hitting a lot of investors' portfolios.
Yeah, I think there is an argument here that breaking issue in a broad AI sell-off isn't a totally fair verdict on the company, especially given the profile that was punished this week. Things like heavy AI CapEx exposure and negative free cash flow. I think there's some element of that here, but I do wonder how much of that really played into the trading and how much was simply an ugly outcome of price discovery.
And I want to talk a little bit more about that, but first, now is probably a good time to mention that SpaceX was not added to the Renaissance IPO Index on a fast entry basis. It will be evaluated for inclusion at the next quarterly rebalance in September. But Avery, I know last month we commented on how, SpaceX was sort of priced to perfection. I still think that the $135 offer price was not totally egregious. It looked like maybe it offered 20% relative upside from there, and it kind of traded there initially. But that is the downside of using relative valuation. Some of SpaceX's comps, like Rocket Lab, AST Space Mobile, CoreWeave, are down 20 to 40% over the past month. So you've got some added competition from Facebook slash Meta, and now everyone's wondering if the debt is going to get more expensive via these higher interest rates, potentially down the line. All that on top of a fast approaching lockup release that will more than double the tradable float in the next month. So, that lockup is something that we've beaten the drum on as a technical overhang coming in August.
And all of those things play into the real question, which is what does this do to the fall IPO calendar? Does a wobbling SpaceX make the next mega deals priced more conservatively, or does it make them wait entirely?
Yeah, I think history says that issuers will read the tape. A humbler SpaceX in the aftermarket might attract healthy deals down the line, resets expectations before they set terms.
Mhm. But now, SpaceX aside, next week should actually be interesting because the calendar is about to completely change flavor. Jersey Mike's and Cumberland Farms could both launch in the coming week. So we have subs and convenience stores, and I think that's about as far from AI infrastructure as you could possibly get.
Mhm.
And beyond that, we have Reformation waiting in the wings. So, well, yeah, a lot of consumer names potentially coming down the line.
The timing is fascinating here. We've got a sector like consumer that's just been punished all year long. Just remember Bob's, Suja, Once Upon a Farm. Now, two consumer names are potentially testing the water right as some money rotates out of AI.
I think Suja was the big one. I think that's got to be down still like
Yeah,
50% from the
I
IPO.
was surprised Bob's and Once Upon a Farm have come back, but there's no way Suja's climbed out of that hole yet.
Yeah, no. And that rotation might actually be the opening that they've been looking for. If investors are looking for somewhere to redeploy, a familiar brand with real cash flow might suddenly look a lot more attractive than it did even a few months ago.
Yeah, I think we're going to frame this as a genuine test of breadth. A healthy IP market can price a subchain and a data center in the same season. A narrow one can't.
Yeah, and these are known brands with long operating histories. I think there is a case that if these consumer stores can't find demand, the sector could stay pretty frozen for the rest of the year. Though I do think it's worth noting that the structure of these deals may play into their outcomes just as much, if not more, than the sector aspect itself, for better or worse. Both of these are LBOs, and PE deals have delivered pretty mixed trading this year. I'm not sure, I should have looked if they're averaging a loss, but I know that it was pretty close at the end of the quarter.
With some new concerns over the interest rate question, I think pretty
Mhm.
valid too.
Yeah. Now taking a quick look down the pipeline, because the filing activity is quietly picking up. We expect a slightly busier calendar late July into early August. We have biotechs leading the recent filers. That's a sector that can often defy the broader market to an extent, because company-specific news often drives the trading. On top of the fact that drug development is very expensive, so they can't always wait for the ideal market.
And I think a lot of that is driven by M&A. If there's a, say, 10% chance that a biotech is now an acquisition target, that just changes the calculus at IPO. And then the mix beyond biotech is pretty eclectic. We've got nuclear equipment with Holtec Nuclear, men's fashion with tailored brands. You may know them from Men's Warehouse. And then South American power production with YPF Energía.
Hmm. Yeah, it's notable that nuclear and power names are still filing into this sell-off. I think some may be conviction that AI power demand will outlast this current wobble, but I do think there are some that were just already in motion and kind of hoping to catch the last of the tailwinds.
Oh, that's definitely true. I'm sure companies, if they could snap their fingers in price when markets are at their peak, they would definitely do it. And now you're kind of getting these catch-up companies. But it can be good for investors, now that the discipline's there and asking for a better valuation.
Mhm.
But that diverse filing slate is a good sign regardless. Issuers across sectors still think the window is worth using.
Hmm. Yeah, I was surprised to see yeah, Men's Warehouse. I don't know if you're a fan of The Office, Matt, but it always
Oh.
makes me think of I worked at a warehouse, Men's Warehouse.
Yeah.
Anyways,
Is
uh,
Sparrow public? Is that a public company? It can't be.
I have no idea, but yeah, my favorite little secret New York pizza
Oh
slice.
yeah, for sure.
And with that, let's look at the scoreboard. This was the roughest week for the IPO index in a while. It finished the week down 8.3% compared to the S&P down just 1.6%. So that's a nearly 7-point gap in the wrong direction, a mirror image of the outperformance we were highlighting just a few weeks back.
As you might expect, the losers were almost all AI names. Astera Labs at the bottom, down nearly 27%. So when the chip complex sells off, the IPO index feels it more than most.
But given everything we've discussed so far on this podcast, the winners column is the most interesting story because we have SailPoint up 14%, Figma up 13%. So the money rotating out of AI went somewhere, and this week it went to software.
And that's a real shift. Software was the frozen sector for most of this past cycle. Now it's leading the winners in a down week. That's a real signal, not just noise.
And it echoes what we've been tracking, which is software showing signs of life, right as software issuers start circling the calendar again. So even after this very challenging week, at least we can say the tape and the pipeline are starting to line up.
And it's just really interesting that software appears to be a counterweight to AI stocks. Earlier this year, everyone was afraid that AI would eat up software, but now when AI pulls back, software leaps ahead. These are both companies in the tech sector, but I guess software is the yin to AI's yang. If AI does pull back, then it's not going to totally destroy the software industry.
I guess
What,
this was the antidote to the SaaSpocalypse.
Yes. The revenge of the Sasquatch. I don't know how you sounds like a movie.
hmm yeah, we're gonna have to trademark that. Nobody take
Yeah.
that, please. So, zooming out now, what did this week actually tell us? The 2026 playbook just got its first real stress test. AI infrastructure deals are stumbling, SpaceX below issue, the index down 8%. So we're seeing these themes that carried the market that they're not bulletproof.
But also look at what didn't happen. The window didn't close, not yet. Deals still priced, filings kept coming, and the index still up 15% for the year. So far, this is a repricing and not a rejection.
The circular spending concern around AI is the one to take seriously, though. That's not a one-week headline, and it's one that we've kept seeing.
Mhm.
It's a structural question about how much of this demand is real.
At the same time, like we said when SpaceX went public, it may be best to think of the AI thesis as a generally generational investment. Sure, you should have some healthy skepticism around companies with multi-billion dollar valuations and no revenue. At the same time, many of these companies are pitching a 5 to 10 year time horizon. Yeah, this week's rotation into software might be the healthiest thing that happened this week. A market that can move money between themes is more durable than one riding a single theme.
Yeah, but there was still some element of discipline. Buyers are scrutinizing everything, and that's clear.
hmm Now, the question is whether issuers adjust, if we see humbler valuations, tighter deals, or if they keep testing a market that just showed some limits.
Mhm. All right, so what are we watching next week? First, Jersey Mike's and Cumberland Farms. Both of those could launch, and they will be the consumer test. If punish sectors can find demand, that's a strong signal of the range that we've been looking for.
And of course, SpaceX's tape, does it reclaim that $135 offer price, or does breaking issue become the new normal? Every mega IPO candidate in the pipeline is watching that chart.
Yeah, and the AI sell-off itself. Another bad week, or the start of a deeper unwind in the circular spending story. Astera Labs and the ship names will probably tell us pretty fast.
hmm So the market flexed its discipline this week. Now we find out what it wants to buy next.
Yeah. So that's it for this week's winners and losers. Get the full newsletter in your inbox by clicking the link in the description. Thanks for listening, and before we go, please listen carefully to our full disclosure. This podcast is for informational purposes only. Renaissance Capital statements should not be considered investment advice or a recommendation to buy, sell, or hold any particular security. Certain of the statements contained may be statements of future expectations and other forward-looking statements that are based on Renaissance Capital's current views and assumptions and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements. Past performance does not guarantee future results. One cannot invest directly in an index.